So there are two ways to pay rent: earn it or own something that pays it for you, some, most, or all of it. This video is about the second way and the 5 stocks that get you there. In this video, John has $100,000. He's going to put it into one of 5 monthly dividend stocks. As we move up the ladder, each one pays more than the last, but each one carries more risk than the last one too. And by the end, I'll show you a stock that pays John around $2,000 a month in rent money, but with a problem most investors don't see until it's too late. Here's the thing about most dividend stocks: they pay you once every 3 months. Your landlord doesn't take a quarterly payment, neither does your power company. So a stock that pays you every 3 months is fine for retirement someday, but it's not how you actually live. Monthly dividend stocks were built for that gap. They pay you on the same schedule your bills are due. That's the whole category. Now, average rent in America right now is around $2,000 a month. That's on the higher end because expensive cities pull the average up. Some cities are way over, some are way under. But for this video, we're going to use $2,000 a month. That's the number every stock in this video gets measured against. $2,000, the bar. With that in mind, let's start at the bottom of the ladder with the safest stock on the list. And remember, every step from here, the risk goes up too. John starts with the most famous monthly dividend stock on the market. So famous, it actually trademarked the name the Monthly Dividend Company. If you walked into any dividend investor's portfolio in America, this stock is probably in it. It's the default. It's also a REIT, a real estate investment trust, which sounds complicated but isn't. It's a company that owns real estate and is legally required to pay almost all of its profits back to shareholders. That's why REITs pay such high dividends. They have to. Realty Income specifically owns over 15,000 commercial properties across America: Walgreens, Dollar General, FedEx warehouses, gas stations. When those tenants pay rent to Realty Income, Realty Income pays a slice of it to you every month. And here's the part that matters: Realty Income has paid and raised its dividend every year for 32 years straight. Through 2008, through 2020, through every recession and rate hike and panic in between. So John looks at all that and asks the question he's going to ask about every stock in this video: what am I giving up to get this? With Realty Income, the answer is simple. He's giving up yield for safety. Here's what that looks like in numbers. Realty Income yields 5.26%. So on $100,000, John would collect $5,260 a year in dividends, which comes out to $438 a month, paid like clockwork on the same day every month. Now, $438 a month isn't going to pay anyone's rent in full, and if John's living in a place that costs $2,000 a month, the average for most of America, Realty Income covers only about 22% of that, a little over a fifth. The rest is still on him. Realty Income isn't trying to pay John's rent, it's trying to make sure his money doesn't go backward while he waits. And for a lot of investors, that's exactly the right deal. 22% of the rent is still something, but the goal is more income. And the moment John reaches for it, he's also reaching for the kind of stocks that almost died in 2008. In 2008, most BDCs cut their dividends. Some cut them in half. Some disappeared completely. The same thing happened in 2020. Every BDC John could name took some kind of hit. Well, almost everyone. One stood out, and that's where we're going next. But first, what is a BDC? A BDC is a business development company. And the easiest way to understand them is this: there are companies in America that are too small to borrow from Wall Street, yet too big to walk into a regular bank and ask for a loan. They sit in the middle. A BDC is the company that lends to those businesses. The BDC borrows money cheap, lends it expensive, keeps the spread, then pays you the difference monthly. Now, Main Street Capital is one of the biggest publicly traded BDCs in America, around $4.7 billion in market cap. Internally managed, meaning the people running the company are employees of the company. Their interests are aligned with the interests of shareholders. That alone makes it unusual. Here's what makes it really unusual, though. Main has never cut its regular monthly dividend. Not through 2008, not through 2020, not through all the rate cycles. While most of its competitors were slashing payouts to survive, Main was actually paying extra dividends on top of the regular ones whenever business was good. So John looks at this, and his next question is the obvious one. If Main survived when everyone else cut, how risky is it really? And here's the honest answer. The dividend held. The share price didn't. In 2008, Main's share price dropped about 40%. In 2020, it dropped over 50% in a matter of weeks. The income kept showing up, but the account value John would have been staring at, well, that fell hard. Surviving the dividend isn't the same as surviving the price. That's the BDC trade. So what did surviving every recession actually pay? Main Street yields 8.47%. On $100,000, that's $8,470 a year or $706 a month in income. Now again, $706 won't get John a whole apartment in most U.S. cities, but in cheaper markets like Tulsa, Wichita, or Memphis, it gets him close to a studio or about half of a basic one-bedroom in places like Indianapolis or Columbus. If John's living in that $2,000 a month average rent space, Main Street covers about 35% of it, a third of his rent paid by one stock. The dividend is almost double what Realty Income paid from a stock that survived everything the market threw at it. Main is what a BDC looks like when it's done right. But right doesn't mean safe. It means the dividend probably holds while the share price falls. That's still a risk John has to be okay with. So 2 stocks in, John's gone from $438 a month to $706, and his risk has barely moved. But the next 3 stocks are where the real income starts, and by the end, you'll see one paying $1,966 a month, almost the entire rent, from the same $100,000, but with a hidden trap. So Main is the gold standard in BDCs, but what if John's willing to take some more risk for a smaller BDC doing the exact same thing, paying him even more? What would he have to give up to take that deal? Capital Southwest is in the same business as Main Street, lends money to mid-sized U.S. companies, same model, same kind of borrowers, same monthly payout. But it pays more. And here's where it gets interesting. Its share price has actually grown faster than Main's over the last few years. So now John's question gets sharper. If a smaller version of Main is paying more and growing faster, why isn't everyone in CSWC instead? Let me show you what John's actually looking at. CSWC is also a BDC, same lending business, but smaller, about $1.4 billion in market cap versus Main's $4.7 billion, roughly a third the size. And it pays a higher yield than Main, higher monthly income on the same $100,000. That's the appeal. So what's the catch? Well, there are 2. First, less diversification. A smaller BDC has fewer companies in its lending portfolio. If 3 borrowers default at Main, it's barely a ripple. If 3 default at CSWC, it's a real wound. Same number of bad loans, very different impact. Second, less liquidity. Smaller stocks have fewer buyers and sellers, so when the market panics, CSWC's price swings harder than Main's. Bigger drops, sharper recoveries. The ride is rougher in both directions. That's the deal. Bigger income on the way up, worse damage on the way down. Here's what that bigger income actually looks like. CSWC yields 10.99%. On $100,000, that's $10,992 a year, which works out to $916 a month. In a big city like LA or Boston, $916 doesn't get John very much, but in a market like Toledo, Wichita, or Tulsa, that's a whole studio. Full rent, covered, with money left over for utilities. Step up to a mid-sized city like Cleveland or Indianapolis, and it's most of a one-bedroom. Against the $2,000 average rent target, CSWC covers about 46%, just shy of half. This is the first one on the list where John could actually live somewhere on this income alone without working another day for it. Next up on John's list is Saratoga Investment. There's a line in the dividend world. On one side of it, you have stocks with real businesses, real income, and risk you can actually measure. On the other side, you have stocks that look like they're paying you, but they're actually selling you back your own capital. Saratoga sits right on that line, 1 foot on each side. Let me explain. It is the same business model as Maine and CSWC, but much smaller, only around $360 million in market cap, less than a tenth of Maine, and it focuses on what's called the lower middle market, even smaller businesses than CSWC lends to. So John's question this round changes. It's not what's the catch, it's where's the cliff? And there are 2 warning signs to talk about. The first is external management. Now, most of the BDCs we've covered are internally managed. Employees run the company. Their paychecks depend on the company doing well for shareholders. Saratoga isn't like that. It's externally managed, meaning a separate firm gets paid fees to run it. Here's why that matters. That outside firm makes more money when SAR gets bigger, whether or not shareholders are getting richer. It's a structural conflict of interest. It doesn't always end badly, but it's a real risk that doesn't exist with Maine or CSWC. The second concern is the borrowers. SAR lends to smaller, riskier companies compared to Maine or CSWC, and those companies SAR lends to pay higher interest rates because they have fewer options. That's where the extra yield comes from. It's also where the extra default risk lives. So is SAR still a real investment, or is John gambling at this point? Honest answer, it's still real, but barely. Saratoga is one of the better externally managed BDCs out there. The income has been steady, the price has held up, but one of the better ones in a flawed category, that isn't the same as safe. Here's what living right on the edge pays. Saratoga yields 14.67%, so on $100,000, that's $14,670 a year or $1,223 in monthly income. Now we're talking about a different conversation entirely. This isn't some of John's rent, it's most of it. He could walk into a 1-bedroom in Charlotte, Nashville, Phoenix, or Indianapolis and the rent's paid for. Whole apartment, done. Even in pricier markets like Denver or Salt Lake City, $1,223 covers a comfortable studio outright. Against the $2,000 average rent target, SAR knocks out about 61%. This is the highest yield on this list that John can defend with a straight face. The income's real, the business model works, the risks are real, but knowable. The next stock pays even more, but the next stock isn't on the same side of that line we just talked about. Pennant Park Investment Corporation, another BDC, same kind of lending business as Maine, CSWC, and Saratoga, but the yield on this one is different. It's bigger than anything we've covered, almost double Saratoga's. So John walks up to PNNT thinking, well, if SAR was the highest yield I could defend and this one pays more, what changed? The answer is the most important lesson in this entire video. Stay with me here, because what I'm about to show you is the one concept that separates investors who get rich from dividend stocks and investors who get wiped out. Yield is a fraction, just two numbers. Annual dividend is on top, share price is on the bottom. So there are two ways a yield goes up. The first way is the good way. The dividend goes up. A company is paying you more this year than it did last year because it's a growing business, sharing its growth with its shareholders. The second way is the bad way. The share price actually goes down. In this scenario, the dividend stays the same or even drops, while the share price collapses faster. So basically, the yield looks like it went up, but it didn't. The company just got cheaper because something's wrong. Two stocks can show John the exact same yield. One is a gift. The other is a warning. The difference is everything. PNNT is the warning. Let me show you the chart most yield chasers never look at before they buy this stock. This is what PNNT's monthly dividend has done over the last 10 years. In 2016, PNNT was paying about 28 cents per share per month. In early 2017, they cut it, dropped it to 18 cents. That's a 36% cut. In mid-2020, during COVID, they cut it again, down to 12 cents, another 33% gone. After that, it went up, climbing back to around 21 cents in mid-2023. Then, in late 2023, they cut it a third time, hard, from around 21 cents down to about 7 cents, a 67% cut in a single move. Net result over a decade? PNNT's monthly dividend is down roughly 75% from where it started. So when John sees that big yield on the screen today, it's not because Pennant Park is paying him more, it's because the share price has collapsed faster than the dividend got cut. That's not a high-yield stock, that's a falling knife with a dividend attached to it. Now, here's what PNNT actually pays today. Pennant Park yields 23.59%. On $100,000, that's $23,592 a year, or $1,966 a month in income. Stack that next to the $2,000 average rent target, and the dividend nearly pays the entire rent. But here's the part that makes PNNT different from every other stock we've talked about. The dividend cuts aren't even the worst part. The worst part is what happens to John's capital while he's collecting the income, the dividends. Over the past decade, PNNT lost about 4.72% of its share price every year on average. So let's actually run the math on what year one in PNNT looks like. John invests $100,000. Over the year, he collects $23,592 in dividends. That's real, a beautiful number. But over the same year, his $100,000 shrinks. The share price drops 4.72%. That's $4,720 in capital lost. Gone. Net return for year one? About $18,872. Yeah, it's still high, the math still kind of works, but now run that same pattern forward 10 years. By year 10, John's $100,000 is worth only about $64,717. He's down 35%, and the monthly income, if the dividend somehow holds, which the cut chart says it most certainly won't, that monthly income drops as well, from $1,966 down to around $1,272. Yeah, because here's how it works. The income shrinks as the account shrinks. The rent-covered promise melts year after year. The thing John bought to pay his rent slowly stops paying his rent, and his capital is gone too. PNNT pays John's rent today. It probably won't in 5 or 10 years. And the $100,000 he started with will be worth only around $64,000 by then. That's the trap. The number that looks the most like rent is actually the one most likely to to take John's capital away instead. And most yield chasers never see this until the capital is already gone. So here's what John's actually looking at. The question isn't which one pays the most. PNNT obviously pays the most. That's not the question. The question is, which one matches what John actually needs? If he wants reliable income for the next 30 years and he's okay with low payouts, Realty Income or Maine. Income that'll show up when he's 70 years old. If he wants meaningful rent coverage and can stomach moderate risk, CSWC or SAR, half to most of his rent paid by stocks that will probably still exist in 20 years. But if he's chasing the headline number, PNNT. He'd better know exactly what he's signing up for, though, because the math says he's not buying income, he's buying back his own capital, $1,966 at a time. Now, if you wanted to hit $1 million in 10 years, starting from zero, I built a fidelity plan that does exactly that, and I'll show you exactly how John reaches it. That video is on screen right now.